It's FOMC day. What is the Fed going to say, and what might that do to the markets? That's coming up on 3 Minutes on Markets and Money. Market futures pointing slightly higher this morning after really 2 days of kind of just a slow grind higher. It's been really volatile for the last 2 days. Markets not really gaining a lot of traction here. A lot of trepidation going into the Fed meeting today. What's the Fed likely going to say? That's going to be the big risk to markets. Will the Fed come out and do 50 basis points in terms of their hike and announce their quantitative tightening, their balance sheet reduction to start at $90 billion a month starting in June and continuing forward from there? Or will they come out more aggressive, hike rates 75 basis points, announce more 75 basis points increases as well? That would certainly probably spook markets here a bit if the Fed is a lot more aggressive. My suspicion is that the Fed will come out in line with what expectations are that have already been set. A 50 basis point hike, an announcement of tapering to start in June. That'll run about 90 to 95 billion a month. If that is the case, and particularly if the Fed does suggest that maybe we've seen the peak in inflation, that could certainly bode well for stocks. Again, coming off this deep oversold level for the market, we're 2 standard deviations below the 50-day moving average. Got a good setup here, holding support for the last few days here, this support level going all the way back to September. That really kind of sets the market up for a nice rally. The good news is that money flows have been actually positive despite this kind of market gyration over the last 2 weeks, and that has now triggered a money flow buy signal at a fairly low level. So again, there's nice catalyst here with any bit of good news. And actually, I should say just any bit of expected news from the Federal Reserve. We could see the markets respond positively here. Again, lots of negative sentiment. We've got sentiment at very oversold levels. Technical indicators are all oversold, really kind of across the board. And a lot of these technical indicators at very deep conditions that are generally found around at least short-term market bottoms. So again, if the FOMC comes in line with kind of what expectations are, it would not be surprising to see this market start to get a bit of a rally here. Target would be about the 50-day moving average, right around 4,300. At that level, I would certainly suggest looking to rebalance portfolios, reduce risk, and think about what the headwinds are coming down the road here as we start to see inflation recede, economic growth slow, and again, earnings are going to be impacted, and earnings estimates are still way too high in markets currently. The reason that I'm suggesting that you use any rally here back to the 50-day moving average to reduce risk and raise a little bit of cash, particularly if you're very heavily long equities and haven't liked the structure of the markets this year, is because the markets are still in a very defined downtrend at this point. Support is holding here going back to this September level. This is leading to a very confined channel that the market is working in, and the top of that channel is running right around the 50-day moving average, and we have a crossover of the 20-day below the 50-day as well. So whatever rally we get will likely be fairly short-lived. Now, if we happen to break out of this downtrend channel, get above the 50-day, then we run into the resistance again at the 200-day moving average just above that. So just as the market begins to rally here, there's still a lot of resistance overhead. There's a lot of indications suggest downward pressure on prices a little bit longer term this year. And we do have a lot of uncertainty around what's going to go on with inflation, economic growth, tighter monetary policy, higher interest rates. So headwinds are certainly outweighing the tailwinds for being aggressively long equities. So again, use this rally here to reduce risk, raise a bit of cash. Think about bonds as hedges for your portfolio, particularly as we do get in a slower environment. Those should start performing a lot better. And bonds have been in one of the biggest bear markets since the early 1800s. When you talk about buying assets cheap, there are asset classes out there that are in a good position to add to portfolios. And that wraps up today's edition of 3 Minutes on Markets and Money. See you tomorrow.